Completely unreliable, completely irrational. But that's what we thought. We thought we'd gone from $6 trillion of wealth to $13 trillion of wealth. Then the market collapsed, dropped all the way back down to $6 trillion. What was the impact? Anybody who bought a home from 2004 to 2007 or refinanced money out was stranded in that asset. Now, there's tens of millions of voters stuck in that asset class. Look at the bottom line, farm and ranch land. How many voters are connected to that line? Tens of thousands, right? So who is the Federal Reserve concerned about in this market? The black line or the red line? They're concerned about the black line, right? But what's the impact of mortgage rates on farm ground? Very clear. When you can borrow money cheaper and you're producing more income, what are you going to do on the price of ground? You're going to bid it up, right? There's no way for the Federal Reserve to focus their monetary policy on homeowners and not hit the farm and agricultural ground market as well, because they're all done through the 10-year Treasury market. So we're going to be collateral damage when these mortgage rates necessarily go back up, because I guarantee you 3.25%, 3.5% 30-year fixed money is not a reasonable number. Ask yourself this question. Even the best credit risk in the world, would you want to give them money for 30 years at 3.5%? Even the best credit risk. The answer is no, you wouldn't. Not when you know there could be pretty good inflation over the next 5 to 10 years. So why is the market giving away money at these rates? Because the Federal Reserve is artificially manipulating those prices. In a system, when you artificially manipulate a system, it comes back and bites you. So right now, they're trying to fix the housing market, and they're also influencing the land market. Monetary policy hits everybody. Now, what about exchange rates? Interest rates also influence exchange rates. Here's the trade-weighted dollar, back over 40 plus years. I want to point out two particular events. Look at the early 1980s. We had a very, very strong dollar. Why? Because of high interest rates. When you have high interest rates in your country relative to the rest of the world, what happens? Hot money flows into your economy looking for a place to invest. And as they flow into your economy, they buy more of your currency and drive up the price of your currency. And then what happens when your interest rates come back down? Well, so does your currency. What was the late 1990s, early 2000s? That was a raging stock market. Neither one of those two events where we had an ultra-strong dollar was about the trade balance. It was about artificial exchange rates. What's happening right now? The last 4 or 5 years have been extremely weak for the dollar because we've had a very weak interest rate. So once again, the interest rate, which is being manipulated for a different purpose, is also impacting the value of the dollar. And the impact from the exchange rate is beneficial for agriculture in the short term. Let's take a look at our trade balance in agriculture, forestry, and fishing. Go back to 2007, we had a $3.5 billion trade deficit in those categories. 2012, we had a $22.5 billion trade surplus. That's a $26 billion gain for the American economy thanks to a swing. A lot of that was being driven by the exchange rate issue. Now, who made the big drive for us? One country. Anybody want to guess which one country made the big difference for us? China accounted for over 90% of the improvement in our agricultural trade balance. That's a great number, and it's also scary at the same time. Because when that much of your gain is based on one country, you really have to worry about what's going to happen in that country. Look at this. In 2007, we had a $2.6 billion trade surplus with China. Last year, we had a $22.1 billion trade surplus. The only other major improvement was in North America. We went from an $8 billion deficit to a $2.6 billion deficit. The other ones kind of bounce around. What improved in North America? What improved in the NAFTA market? We stopped building homes. So we didn't import Canadian lumber and timber. So there was most of the improvement. Two things, China and not building homes. Now what about China? Oh, we'll go back. Got the China slide here? No. I want to point out a particular market. I was just down in Sioux Falls this morning talking to dairy guys. Look at what happened in U.S. dairy dynamics. You guys probably aren't in the dairy market, but you can see that we've got to be a net exporter in dairy. It's been a huge win for them. The problem is, if you're depending on this to maintain your dairy exports, and you have a lot of volatility, you could be in a lot of trouble. Now, I want to make sure that you don't get the impression that I'm bearish on the U.S. economy. There's a difference between preparing for contingencies and looking at risk and being bearish. I'm very bullish on the long-term outlook for the U.S. economy on a competitive basis. And two areas in particular I want to highlight, energy and agriculture. Let's start with energy. This has been an incredible win for the U.S. economy. Take a look at what we've done over the last couple of years. We've gone from 5 million barrels of oil production to over 7.2 million barrels of oil production on a running basis. Right now, we very well end up the year closer to 7.5 million, even 8 million, depending on how much drilling we see going on the rest of this year. That's a huge win for the U.S. economy. At the same time, high prices of crude oil and high prices of gasoline have killed energy demand in this country. We went from 21 billion, a million barrels a day down to about 18.5. So between expanding domestic production and reduced domestic consumption, we've seen this happen. We've seen about a 6 million barrel per day decline in imported crude oil products. That's a huge win for our economy. That's worth $175 billion a year. On top of the agricultural pickup of $26 billion, that's a $200 billion plus improvement in our trade deficit. When you look at our trade balance, almost every single dollar of our trade improvement has come from either energy or agriculture. Now, manufacturing is helping a little bit, but these are the primary drivers. Now, we've got some issues. One of the things I'd like to talk about in agriculture is what about natural gas? Natural gas is a real buy today. When you look at whether you want to drive with natural gas or you want to use electricity, whether you want to put in a pump that's based on electricity or natural gas is a hands-down winner. But we've got to be careful here. I want to make a point. Looking at risk, anticipating change. This is a price ratio. I'm looking at the price of crude oil to the price of natural gas. Historically, there's always been a trade in this market. It's noisy, but the trade was pretty constant. There's about 6 million BTUs in a barrel of crude oil. BTU is an acronym, British Thermal Units. It's a measure of energy. And we sell natural gas by the BTU. 1 million BTUs is a standard measure. So if you go back and look over the last multiple years, prior to 2008, natural gas and crude oil kind of traded at a 6 to 8 range on an ongoing basis, ups and downs. Starting in about 2006, 2007, that ran away from that ratio and exploded over the last couple of years. Natural gas has been dirt cheap relative to crude oil. And the question is it going to stay there? Should you invest in natural gas usage and back away from crude oil? Well, if you do, you should lock it in because things are changing. Markets react. This is another example of looking at anticipation. What we have here in the yellow part is drilling for natural gas. The green is drilling for crude oil. Clearly, you can see why we're seeing explosive growth in our crude oil production, because we're putting out more rigs drilling for crude oil than we've seen in multiple decades. At the same time, though, we're driving down natural gas drilling rigs because it's not that profitable. What else? Usage. I'm just pointing out, I'm just scratching the surface of how these markets react. The black line is coal-fired generation for electricity, and the red line is natural gas generation of electricity. Once again, dramatic changes in usage. So we're drilling for fewer natural gas wells, and we're using more natural gas. The implications are pretty clear. I can't predict the price of natural gas. I can't say when you're going to see it rise relative to crude oil. But clearly, the market's trying to fix this problem. And the reason I'm bringing this up to this room is the same thing's happening in corn. The same thing's happening in livestock. We just don't see it as clearly sometimes as we see it in some of these other markets. Now, agriculture. Let's finish up with agriculture. I'm not bearish on agriculture. What I want people to do is to be very, very careful about how they want to invest in agriculture. Is it a new era? I don't think so. I think it's a global market that's always going to be competitive. We have a lot of policy things we should discuss, and there's some implications. Here's a chart that hopefully you might have seen something like this. This is 100 years plus of cash corn prices. Now, you won't recognize it's on the left-hand side of the chart because I'm using a logarithm. I know you guys love logarithms, right? You guys put everything in logarithm, right? Well, every morning you convert your P&L to logarithm, right? No, you don't. But what a logarithm does for you, it helps you see things that might be exponential in a more linear fashion. And people are very good at looking at linear things and very bad at guessing at exponential things. But the main point of this chart is one thing. We go through different eras, and you hopefully have heard this before. Pre-World War II, post-World War II. Pre-oil embargo, post-oil embargo. And for a lack of a better term, pre-biofuels, post-biofuels. Now, the question is, what's the new price? We've had that discussion already this afternoon. What's the new price of corn? I don't know. There's a lot of uncertainty around there. But clearly, we're not at the old average that we used to have. Every time you go up one more, you double under this scale. Now, I'm not bearish on demand. I can see these things. Here's global GDP. Global GDP continues to grow and grow well for us. More people with more money. You've heard that story over and over again, and it's true. There's the money, there's the people. Both of these trends are clearly strong and upward. There's no problem with the growth. The problem is, what about the volatility? Think about 2009. We had never seen in the last 40 years a global GDP contraction as measured by the government. We saw one. It had a huge impact on commodity values. And the question is, will we see another one, and if so, when? What would trigger it? I have no idea. But if you've seen one recently, the odds of seeing another one are higher. How much higher? I can't quantify that. But it has to be part of your thinking about how do I mitigate risk and what am I doing about it. Now, the markets are random. The markets are unpredictable. What they give you, they'll take away. Let's look at corn for a second. Here are some numbers that really should catch your eyes. You guys have seen a lot of marketing people talk about the corn market. This is nothing new. But it's just remarkable to see how low our exports have gotten this year. 900 million bushels. I mean, it's interesting. You go back and look, if you were to make these predictions a few years ago, they would have been considered extreme cases. And it really was an extreme case. A 20% decline in yield. What about the coming year? I don't know. You know, if we have 97 million acres of corn at a 160 bushel yield, that's a big if, you get 14.5 billion bushels of corn. And I've already had the conversation today, and it's a good conversation. What about subsoil? What about forecast? What about stocks? You know, those are all fundamental risk factors. But here is what the USDA is pushing out. This is pretty much where they're at. Except on the demand side. I push those numbers a lot harder. But even with pushing up some of those numbers pretty hard, you still have a much bigger carryover. Now, will we get 14.5 billion bushels? I don't have a clue. We are 4 to 5 months away from knowing what the yield is going to be with any real certainty. But what's your contingency and what's your scenario that you're building in? What are you protecting against? What's your risk mitigation? Let's talk about ethanol. This is an interesting thing. This gets me in trouble, quote unquote, when I'm in ethanol country. People don't like to hear anything negative about ethanol when they use it, when they sell it. But you know what? There's a lot of issues in today's ethanol market that weren't there a few years ago. I believe we never anticipated this week of demand for gasoline. The renewable fuel standards never built in a mechanism to cope with declining gasoline consumption. Every single assumption in our renewable fuel standards was rising gasoline consumption. So you got to adjust for it, but there's no adjustment policy built into it. They haven't been making money, we know that, and we have no import tariff in place anymore. You can import Brazilian ethanol without an import tariff. With the collapse in global sugar prices, there's a real risk that we're going to see more Brazilian ethanol in the Houston market, in the New York Harbor market, than we ever anticipated. We have more unknowns than we did 3 years ago. Gasoline demand that we talked about earlier, declining, not anticipated. We've gone through a very unique phase. The red line is domestic consumption of ethanol, and the black line is domestic production. Clearly, from 2010 to about 2012, where we're at right now, we got December numbers out this morning, we were able to produce more ethanol than we were consuming. We clearly flattened out on ethanol consumption back in the beginning of 2011. How do we get away with the growth in ethanol production? Well, we were able to export that product out of the country or build stocks. The question is, what happens when we see a reverse flow of ethanol into the country on imports? What does that do to our pricing mechanism? I hear an awful lot of traders talk about what's going to happen in ethanol. And then I say, well, how do you know the price of gasoline? How do you know the price of Brazilian sugar? And they say, well, we have a model. Okay, well, great. All models are wrong, some models are useful. I don't know about their model, though. So, what about proteins? Another question, big part of our feed usage. Anybody spot the unusual part of this graph? Beef. Beef has been the supply-constrained winner in terms of pricing up in this market. Here's my concern. If we get a more normalized yield, we get a big crop, we get cheaper corn. Cheaper corn helps all livestock operators, but it doesn't help them all at the same time in the same way. Look where beef is. This is what the consumer sees. When the consumer goes in to choose a protein in the supermarket or on the menu board at the local restaurant, this is what they're seeing. Beef's expensive. Pork and poultry and dairy are about the same price. So if we get cheaper corn, what's the impact? Well, I guarantee you that the poultry guys will get to the market first with the cheaper corn. They can put cheap corn into a poult today and have it out the back end of the factory in less than 3 months. The same guy doing cattle who wants to hold back a heifer and then produce a calf and then raise it to slaughter, he's got a lot more time to get that new supply into the market. Pork is someplace in between. So when you look at the pricing structure and think about how it's going to roll to the market, that's a big deal. Because if pork and poultry can push down their prices first, the gap between beef and their pricing is going to get even bigger. And that's going to be a lot of pressure on beef before they're ready for it. So once again, anticipation of how these things cycle. I mean, biology matters. They have different biology and different market structure. This is not a forecast. This is once again a scenario of looking at what's going to happen. So let's finish up here, because I know you're going to have some questions, and you're also going to have Fred Beal, I saw him coming earlier, he's going to have a great presentation. So what? Well, anticipation versus forecasts. Forecasts are always wrong, because it's a time and a price. You're going to be wrong in both of them, typically. One of them for sure. But anticipation is a different animal. Anticipation is saying, what patterns have we seen develop over and over again in these commodity markets, the cyclical commodity markets? Where are we in the cycle? High, low, medium. And what should I be doing to mitigate the risk that I'm going to get sacked by a 300-pound linebacker called the market in the next half year or 12 months? Anticipation is important. I'm not saying throw away your forecast. No, you need forecasts. You need to have operational budgets. When you go to talk to your banker, he's going to want to see a projected P&L. When you go to talk to people, they want to see your forecast. But what's important is having sensitivity around the forecast, having those scenarios. What if the Federal Reserve raises interest rates suddenly and you start to see higher and stronger dollars at the same time? What would you do? What's your short pass? Are you going to tuck the ball and take a 15-yard loss, or are you going to throw an outlet pass and pick up 4 yards? What are your options? What are you going to deal with? Now, before you think it's all doom and gloom, it's not. There's a way that we can make money in agriculture that the traders can't. Traders live their lives trying to outsmart the market. Every single day they're looking for a little edge, some information that nobody else has. They're trying to outguess the markets and be faster. Traders have watches. They live by the second. The people in this room are different. People in this room are investors. You're agricultural investors. And you have time. Just about anything that you want to implement can work if you implement it correctly. Because you have multiple periods to make it work in your favor. You don't have to outguess the market. You don't have to outsmart the market. You just have to be good at what you do in terms of agricultural production. And that's a different challenge and one that everyone in this room can meet and exceed at. So So let me stop there and say, are there any questions or concerns at this point? We're going to have some Q&A after dinner, which is going to be a little scary because you've had a couple of beers by then. And I always say the first beer question is good. It's the third beer question that gets a little bit tough to answer. So any questions or concerns at this point? No? Well, thank you very much.